all of you. We'll begin with another chapter. This one is called process costing. And like before, we'll first take a look at the learning objectives. This is another big chapter, could take us about 12 to 15 hours, that means about 5 to 6 classes to do. It talks about the meaning and importance of process costing, that's where we'll start with. Then there are some valuation rules. So we had contract costing where there was for the first time accounts done up, debit, credit, P&L, balance sheet. Here also we are going to do account. And the one difference in process costing compared to contract costing was that in contract costing, items were picked from the question. In process costing, while items will be picked from the question, there will be a number of things that will be valued. As a result of which, what is going to happen is that the process cost will take the character of a balance sheet. Character of a balance sheet means every in the process cost will be independently worked out and we'll see that the two sides match. That doesn't make it a balance sheet. It's still like a profit statement, but it takes the character of a balance sheet in the sense that the two sides will match up. So for that, there are certain valuation rules. That will be learning objective number 2. Number 3 is what happens when transfers are made at cost. That means when item is transferred from one process to another. In learning objective 1, we'll tell you why transfers take place. But when transfers take place, they can take place at cost price. When transfers take place, they can take place not at cost price, but at a predetermined transfer price. That will be learning objective 4. In 5, we learn the most important one. It's called work in progress, or work in process is the better word. Study material also I think calls it work in process, or I'm not too sure whether they call it equivalent production. Work in process or equivalent production. 6 is the different methods of valuing work in progress or different methods of doing process costing. There are 2 popular methods. One is the first in first out method. Last is the average price method. There was a last in first out method that's no longer used. So make note of these 6 points, and then we'll start with the first, where we'll tackle the meaning and the importance of process costing. We'll look into the meaning and the importance of process costing. So those are 6 ones: meaning and importance, valuation rules, transfer from one process to another at cost price, transfer from one process to another at transfer price, work in progress, also known as equivalent production, and finally the various methods, first in first out, average price method. Okay. From here we'll move on to the first part. First part was what? Meaning and importance of process costing. The process costing basically means a type of costing where there is a raw material, it has to become a finished goods. For a raw material to become a finished goods, it will go through several stages. Just to give you an example, this is not the best example, this is in fact not a very good example, but an example that will help you understand what this is. If you want to go from place A to place B, okay, suppose you are going through place C. So you go from place A to place C, get down, then go from place C to place B. In almost much the same way, what happens is that there is a raw material which goes through process A, gets down at process C, or at the beginning of process C, or we can then say it gets down and gets up at process C to go to process B. In other words, a raw material goes through a series of distinctly identifiable processes before it emerges as a finished product. There is a very simple example that I often give. That example you will see coming up here. But first the definition. It says a type of costing used in an industry where the basic raw material goes through a series of distinctly identifiable processes before emerging as the finished product. Ascertainment of the cost of each process is called process costing. ascertainment the cost of each process is called process costing. Then there are some pictures there. Some words have got missed out, or one word has got missed out, doesn't matter. Left hand far corner, what do you see there? What is called raw material? There are 4 pictures there. First one is cotton, which is called the raw material. What is the last one? Shirt, which is the finished product. What is the middle one? Second and third. If that's not very clear, you can guess what it could be. I think the third one is reasonably clear. What is it? Cloth. That's called the intermediary product. In the making of a shirt is an intermediary product. The second one is also an intermediary product. We wanted to create the picture of a yarn. If that looks like a yarn, good. If it doesn't look like a yarn, imagine it's a yarn. From cotton, it becomes yarn. From yarn, it becomes cloth. From cloth, it becomes shirt. Cotton to yarn is process 1. Yarn to cloth is process 2. Cloth to shirt is process 3. This second one, yarn, and the third one, cloth, they are called intermediary products. They are also what? They are also like cloth. What did I say was cloth? Finished product. They are also finished product. But our company is interested in making shirts. What I am trying to say is that at the end of process 1, if you want, you can use yarn to do the next process, cloth, or you can sell yarn in the open market. That's why we are saying there, goes through a series of distinctly identifiable processes. Distinctly identifiable process means you know that one process has ended and another has begun. You know, yes, yarn has come. Now I will feed yarn to get cloth, or I will sell yarn in the open market. Conversion of cotton to yarn is P1, yarn to cloth is P2, and cloth to shirt is P3. So let's capture that. First one is raw material. Last one is finished product. Middle 2 are intermediary products. These intermediary products are also finished products. The last one is final finished product. The middle 2 are intermediary finished products. You have done? Alright. Then let's move on. What we next understand is why is this important? Why is this important means why is what important? Process costing. It's important because it helps you identify the cost of each process. You know how much does it cost to convert cloth to yarn? How much does it cost to convert yarn to cloth? Cotton to yarn, then yarn to cloth and cloth to shirt. It therefore helps you measure the efficiency of each process. So you might have a budget cost for each process, the actual cost can be different, so you can measure its efficiency. You can also measure the profit in each process. You can also do make versus buy decision. Make versus buy decision means I finish from yarn I complete what? Sorry, from cotton I complete yarn. Now from yarn I have to convert to what? Cloth. Now I can decide whether I want to convert yarn to cloth in my factory, or I can decide whether I will give the yarn to a third party who will convert the yarn to a cloth. That means I will sell to the third party the raw material, okay, namely the yarn, and then I will buy from him the cloth. So that is the make versus buy decision. Whether I should make cloth in my factory or whether I should sell the raw material and convert it into the intermediary product is a decision that we can take if we know how to do process costing. So these are the 4 things that it really helps. Okay. Now if this broad background is understood, we can then go look at how the accounting is done, which will also lead us to the valuation rules, which will also tell us how process cost account will look like. Okay. Once we understand that, then we can take a couple of questions. 2 or 3 questions should be good enough to understand how it works. You're done with this? We are actually getting down to valuation. Okay, we are actually getting down to valuation. I have not put out the heading, but we are getting down indirectly to valuation. Whether we are getting down to valuation or not, we are getting down to accounting. Don't write anything. When you do accounting, that means when you prepare the process 1 account. In our example, what is process 1? Cotton to yarn. Let's not say raw material to yarn because second process, yarn is the raw material. Okay, so we'll say cotton to yarn. If you want to prepare cotton to yarn statement or cotton to yarn accounting, the T account, the regular conventional T account, which says process cost account, then first step you have to do is you have to prepare the statement. You have to write what is the opening stock in units. You have to write what has been transferred from previous process. You will add the two to get the total input. Okay, the X marks can all come in one column. I have needlessly put it in two. From there, we'll subtract the closing stock. It will give us what we call processed production. Okay, why are we saying transfer from previous process? Because the output of a process is the input of the next process. You can either have transfer from previous process or you can have a purchase that takes place in the current process. For example, when you do the first process, you have to buy the cotton. In the second process, when you're converting to yarn, there is no need to buy the intermediary raw material. Then we have process production, that is the equivalent of consumption, but we call it process production. That means that units that got processed. From there, we have to subtract normal loss. Normal loss is a scientifically determined loss. We'll sing the same tale again. What you have already learned in cost sheet, what you have already learned in material, what you roughly learned in labor, same thing, normal loss. In that normal loss can be a percentage of line number 2 or line number 3. Sometimes it can be a percentage of line number 5 also. Normal loss. Then you get expected output. Then there is an actual output. If the expected output is 1000, the actual output is 950. What is the balance 50? Abnormal loss. So if the actual output is less, it is called abnormal loss. If the actual output is more, it is called abnormal gain. This entire statement is in units. This is not in rupees. Okay. So you wrote meaning and importance. The next heading we'll just call it accounting. We'll call it accounting or valuation rules, whichever phrase you like, because some of these statements are not doing valuing. Writing valuation rules is also okay. Principle number 1 is how to prepare. What statement is that? Input output statement. Good. This statement is only and only in units. All these are in units. You've done. So we'll have to figure out what we want to do next. I think what we are next going to do is part of principle. We're going to explain what is normal loss. We're going to explain what is abnormal loss. We're going to explain what is abnormal gain. Also going to say how it is going to get computed. And then we'll use question number 1 more as an illustration. That means as we finish some principle, we'll go to illustration question 1 and work it out. Then as we talk some other principle, we'll go to question number 1 and work it out as an illustration. Okay. I think this is self-explanatory. Normal loss is a scientifically determined loss. It's a part and parcel of the manufacturing process. It is not possible generally to avoid that loss because the making of the product requires that loss to take place. The making of the product itself requires that loss to take place. For example, when you use wood to make table, if you bring 1 kg of wood and make a table and then weigh the table, it will not weigh 1 kg, it will not weigh 1000 grams, it will weigh 900 grams. Why? There are so many things that are chipped and chopped and you get lost. So there is the making of the product itself is such that you will lose. That's called normal loss. Coming to specifics, normal loss is computed either as a percentage of input. Just find out which is the input line. Because I don't think we wrote that word. The second line. Second line is called input. We are very clear about that. Second line means what you wrote as input / transfer from previous process. Total input is the next line, that is opening stock plus transfer, or it can be a percentage of process production. Okay. Normal loss is computed either as a percentage of input or as a percentage of total input or as a percentage of process production. Abnormal loss is a loss which is over and above the normal loss. Okay. It arises when the actual output is less than the expected output. So if you expect that there will be 900 kgs of output, but you get only 900 grams of output, but if the table weighs only 875, 25 is abnormal loss. You expect 900 grams of output, table weighs 925 grams, then 25 grams is what? Abnormal gain. 100 grams is normal loss, 25 grams is abnormal gain, which means that the total loss will be how much? 75. Okay. Let's go do this. You make note of this. Underneath that, then we'll write a very, very simple example. Once you have finished point C, you yourself write D and E. You know what is abnormal loss, you know what is abnormal gain. Then we'll put out an example to understand these three numbers. We've done. Now let's look at D and E. What is D? What is abnormal loss? Loss in excess of normal loss. Abnormal gain is if the loss is less than the abnormal loss. We've done that.